Hello and welcome to the monthly recap. This is for the month ending today, Monday, June 30th. Summer's in full swing. Hope you all have a wonderful summer, wonderful June. Let's get right into it. So this month was really busy. Okay, it was a big Fed meeting. It was a meeting associated with a summary of economic projections. That's where the Fed doesn't just release their decision on the Fed funds rate, but they actually have to put pen to paper and show where they think things are going. It's really interesting because we can show what were they thinking in March compared to what are they thinking in June and compare those numbers because it's very telling as to where they think things are going as a whole. So we're still going to be talking about GDP and jobs and inflation as well, but we're going to be doing it through the lens of the Fed meeting itself. There's also a big month ahead. Talk about that. But yeah, no rate cut. What gives? Talk about that extensively. Mortgage rates did improve on the month. Okay, they ended the month around 6.75% for a 30-year fixed. That's for a first-time home buyer making less than 120% of the area median income. Kind of one of the ideal scenarios. This month for holidays, we had Father's Day. We also had Juneteenth. And yeah, obviously July 4th, right around the corner. So let's get into this. So let's start with data. Okay, let's start with GDP. Now, literally last week, June 26th, we received the final reading, for the first quarter of GDP. So, final reading, first quarter of GDP, that came out on June 26th. That came in at minus 0.5%. I mention that because the textbook definition of a recession is 2 consecutive quarters of negative GDP. We've got one locked up. Okay, so it's entirely possible we're in a recession. We will find out. We only have to wait for another month before we get the first reading of quarter two GDP. So we'll be eyes wide open on that. Anyways, GDP. The Fed is expecting GDP to be lower than they were initially predicting back in March. So how we read this is not a chart Aaron would ever do up. It is a chart that comes directly from the Fed. Okay, so March projections is this dotted line here. As you can see, the brunt of the dotted line was in this 1.7, 1.8 territory. We'll call it 1.7. And if you look at these blue bars, that is their June projections. So in June, they are now predicting it to be closer to like 1.4%. So they have tapered their expectations from 1.7% down to about 1.4% for the year. We shall see. But it shows that the Fed is less optimistic, less rose-colored glasses about what's going to go on with the economy. They think things are going to be slower than initially expected just a few months ago even. That's a pretty significant revision downwards considering it's only March that we're talking about now, March to June. How about unemployment? Let's talk about the jobs market. So similarly, the Fed is less optimistic about the labor market. Okay, so again, dotted line. They thought the unemployment rate, this is the unemployment rate, they thought the unemployment rate would be closer to like 4.3, 4.4%. We'll call it 4.4%, give them the benefit of the doubt. Well, they are now thinking that it's going to get worse than that. They think it's going to be closer to 4.5%. For comparison's sake, the unemployment rate today, according to BLS, is 4.2%. Okay, so they're thinking it's going to go from 4.2 to 4.5%. But again, significant revisions. You can see, hey, wow, there's a lot of members that thought it was going to be in this 4.2 to 4.3 range. Yeah, no, they've all jumped up to 4.4, 4.5. Some members are now thinking 4.6, 4.7 as well. So they think the unemployment rate is going to get worse than they were predicting again just a couple months ago. So they think GDP is going to be slower. They think unemployment is going to be worse. And when we take a deeper dive on the jobs market, you'll see that it's a mixed bag, but it's mostly a poor mixed bag. So JOLTS, job openings and labor turnover. So that might be the one like really bright spot for the month of May. It showed an increase in jobs of 191,000. Now, the reason I say it's the one bright spot, but it's also not great. But it's really hard to know what's going on within JOLTS. JOLTS measures help wanted signs across the country. How many jobs are out there? But since COVID-19, there's been a lot of questions about the reliability of this data because an employer could post one job in Alaska and New York and Colorado and Florida. They could post 4 different jobs, but really in reality, it's one job because you can work remotely now. So anybody could work from their state and work on that job. So it's hard to tell how many jobs are actually real versus how many jobs are duplicated, how many jobs are posted more than one time. Really hard to know what's going on there. Ever since COVID-19, JOLTS has been thrown into question as to how reliable the data is. So bright spot, sure. How much of a bright spot? Nobody really knows. Okay. Now, what we do know is the Challenger Job Cuts report. It shows how many layoffs have occurred. Through the first 5 months of 2025, layoffs are 80% higher than the first 5 months of 2024. 80% is a huge number. Obviously, that's pretty shocking. Let's talk about the Bureau of Labor Statistics report, BLS, which I've since renamed BS report. So we got the May jobs report. It showed 139,000 job gains for May compared to expectations of only 130,000. Great. That seems like a pretty solid number. And it would be if BS report didn't do what they do every single time, which they come up with these crazy large numbers and then they take an axe to the numbers when they release the next set of data and they just say, oops, we messed up. How much did they mess up? Well, for the prior two reports, they revised them down 95,000 jobs. 95,000 jobs. That's shocking. That is ludicrous. That is absolutely insane. I can't believe that the Fed continues to put so much credence and credibility into the BS report when all we do is see these significant revisions that show that their data is not reliable. The Fed or the BLS themselves have come out and said we are understaffed. We don't know how reliable our data is. They've come out and said this themselves, and yet the Fed continues to put just so much credibility and reliance on that data. It's kind of shocking. The unemployment rate went from 4.19 to 4.24%. I colored it yellow. I mean, that's pretty small change. It's not going to really move the needle one way or the other. ADP, their job report, which has been more reliable, for May showed only 37,000 jobs being created. Expectations were for 115,000. In addition to all of this, those that are on unemployment, they've been staying on unemployment longer. We've also seen unemployment each week, initial unemployment claims being elevated and stable. Usually when we see it jump up, it usually comes down. It's been fairly stable and elevated for a while now. So yeah, it seems like there's a lot of cracks in the labor market foundation. And I think the Fed's smart to say we think this is going to get worse. Is it going to get even worse than they're predicting? We shall see. All right, so let's talk about inflation. You know, my favorite topic. So what does the Fed think is going to happen to inflation? Okay, well, this is core PCE. Okay, so personal consumption expenditures, that's the Fed's favorite measure of inflation. Core is when you remove volatile food and energy from that equation. When is the actual number? Again, they don't want to be reliant on, what's going on with, chicken prices or egg prices or oil in the Middle East. So remove volatile food and energy from the equation. What is the actual core personal consumption expenditures? What is the inflation that consumers are feeling? So it came in for May up 0.18%. The yearly figure came in at up 2.7%. Again, the Fed wants this yearly figure to get down 2%. If they did, that would be the Fed's target. Now, the Fed changed their expectation where they think core PCE is going to be from 2.7 to 3.1%. I've shown you a couple charts already, but look at this one. This is where the vast majority of the Fed members were thinking core PCE would be by the end of the year. This has changed drastically. Some are now thinking 3.1, 3.2, 3.3, 3.4. Some even expecting 3.5%. Like, they've revised their opinion on this from March to June. That is not a long window, significantly. They think inflation is going to get considerably worse before the end of the year. Get into talking about why in a second. I know this is a whole long tease, and I'll get there. Let's look at some of the other data we received on inflation. So producer price index, which is wholesale inflation, inflation as businesses feel it. Consumer price index, inflation as us consumers feel it. Now, we also got the headline, which is all in, as well as core, removing that volatile food and energy from the equation. All four of these numbers, so headline, and core for consumer and producer, all came up 0.1% for May. That's very calm. That is a very, very small rating. If we had that 12 months in a row, we'd be looking at 1.2% inflation. We'd all be popping champagne corks, and that champagne would be less expensive. However, what we saw is the headline went from 2.4 to 2.6% on wholesale, so business level inflation. What gives? Even though the number was very tame, the number you replaced from a year ago was even more tame. It's kind of weird, but inflation can come in very mild. But since it's a year-over-year number and one report drops off from a year ago, if the number we're replacing from a year ago is even cooler, zero, negative even, it's going to look like inflation is heating up. And that's what we saw with the headline PPI. Core improved slightly, 3.1 to 3%. Consumer price index, headline went from 2.3 to 2.4%. So same thing occurred. Only up 0.1%, but the number we replaced from a year ago is much cooler. Therefore, we actually see an uptick slightly in inflation. I colored it yellow because, again, 0.1% will take that all day long. Core stayed at 2.8%. So let's look at why it's going to be harder to make some progress on inflation going forward. It's because of this. Like I said, When we come out with a yearly figure, last 12 months, one report from a year ago drops off. Well, here's the reports that are going to be dropping off for core PCE: 0.22, 0.17, 0.17, 0.25, 0.29. So maybe we get some progress in October, maybe a little bit in September, but then 0.1% in November. These are very, very tame numbers. It's not going to be until like January of next year, February of next year, when we're going to come across a slew of numbers that can actually be replaced and show that inflation is going to get cooler. So inflation is going to get worse before it gets better. It will get better. We're going to start replacing these hotter numbers, but it is going to get worse before it gets better. So the Fed is less optimistic on GDP. They think the economy is going to grow slower than they were initially predicting. They think the labor market is going to get worse. They think the unemployment rate is going to tick up. They think inflation is going to tick up. None of this is good news. And what gives? Well, here's what happened at the Fed meeting. Okay, at the Fed meeting in May, let's back up 1 month. The Fed emphasized waiting 22 times. And there was, going into the actual June meeting, there was only a 20% chance the Fed was going to cut rates. Those changed quite a bit. At one point, it was like almost a coin flip, and then it got considerably worse. 20% going into the June meeting of, hey, the Fed might cut rates. And sure enough, they did not. Well, why not? This time, instead of emphasizing waiting 22 times like they did in May, they talked about tariffs. Now, it's really, really fascinating because tariffs will impact GDP. Tariffs will impact inflation, certainly. And the Fed just has a lot of uneasiness around what's going to ultimately happen to inflation numbers. It's really ironic because the Fed is hesitant to cut rates because of the unknown impact of tariffs. Meanwhile, the administration wants the Fed to cut rates to mitigate the impact of tariffs. It all comes back to tariffs. And the reason it's so fascinating is because the administration really wants the Fed to cut rates to mitigate the impact of tariffs. Now, how would cutting the Fed funds rate mitigate some of the impact of tariffs? Well, if the Fed were to cut rates, okay, let's say they cut rates tomorrow by 0.5%. You'd see me all smiles, right? If the Fed cut rates tomorrow by 0.5%, it would reduce the rate on your credit cards by 0.5%. Your personal loans, home equity lines of credit, all these lines of credit would come down 0.5%. So even if tariffs start to increase the cost of those goods, the effective cost of those goods, since it's going to cost you less money to borrow it, is going to come down. Okay, so the Fed truly could mitigate some of the impact of tariffs by making it cheaper to borrow money. It's going to lessen the impact. Right now, unfortunately, it's like a double swing. Like you get, hey, oh, tariffs, and also, rates suck. It's like you're getting hit twice. Well, if Fed cut rates, they would potentially only get hit once. So that's the idea there. The Fed desperately want to cut rates, but they have so much uncertainty. And you can see the uncertainty in those numbers. Hey, they think GDP is going to get worse. Hey, they think inflation is going to get worse. There was multiple members that came out and they said, it might take us another few months before we're really going to know what the impact of those tariffs are. It's still this big, serious question mark. And the tariffs are not showing up in the numbers because when we looked at all the numbers, it was only increasing like 0.1% for PPI and CPI, only up 0.1%. Clearly, tariffs are not being felt in those numbers. In addition, there's this what they call pull forward effect. So a lot of people were spending a lot of money in the first quarter, but they were spending money that they were otherwise going to spend later in the year. They were trying to get ahead of tariffs. So it's really going to be interesting to see when we see that pull forward effect end. When do we see the effect of tariffs actually start to hit the numbers? And then there's just some big question marks out there, which I'm going to talk about in a second here when we look at what's going on next month. So when is the Fed likely going to cut rates? That's the $1 trillion question at this point. Let's take a look at their schedule. So their next meeting is on July 30th. It is not a more major meeting. It's a smaller meeting. It is not a meeting associated with the summary of economic projections. Their next meeting associated with the summary of economic projections is September 17th. Okay. Now, since the Fed made their decision not to cut rates and they came up with their data on what's going on, there has been multiple Fed members hitting the media circuit, and they've actually been talking about, hey, we think July 30th actually might be a decent candidate for a potential rate cut. Now, every Fed member is going to give themselves an off-ramp. Data dependent. Well, let's see what happens to the data. Well, that's true. However, the fact that some Fed members are starting to get in front of this and start to actually talk to the media about, July actually 30th is a potential option is promising. If I was a betting man, I've been known to gamble a little bit. If I was a betting man, I would say it's probably not likely. They're probably going to want to do it at a summary of economic projections meeting if they can. So they could very well kick the can again in July and then do something in September. We shall see. What's working against them a little bit is, well, number one, as I mentioned, inflation is going to get worse. Okay. So if they're waiting to see inflation improve, yeah, they're never going to stop waiting because it's going to get worse until it starts to get better. We're not going to see reliably consistent improvement until, like I said, literally 2026. So the data is probably not going to help them. The data was kind of set up perfectly for them to cut rates at their June meeting, but they did not. July, I don't think is going to be much better, and September is when they have their next big meeting. So if I had to guess, I'd say probably September or July, but we shall see. Maybe momentum does pick up. Only time will tell. All right, let's talk about next month. So we got the July 30th Fed meeting, not a bigger meeting, not associated with summary of economic projections, but interesting nonetheless, especially interesting if they do decide to cut rates and that momentum does pick up for that. We shall see. Fingers really, really crossed. Like I said, it's going to be hard to make up progress on inflation going forward. It's going to be really hard. Maybe we can have a month or two where we see, flatline or maybe a little bit of improvement. But other than that, it's going to be really hard until we get to 2026. Now, big unknowns. This is what I want to talk about. So we have tariffs out there, right? And some of the trade deals that have been negotiated are starting to wobble a little bit, and some of them are starting to fall apart. Some of them are hitting pause. Like, it's not great on that front. There's still a lot of work to be done. One big, beautiful bill passed the House, finally passed the Senate, but now it has to be kind of ratified and agreed to. There's still a long way to go. But the big, beautiful bill is going to cost a big, beautiful sum of money. And in order to do that, they're going to have to raise capital. Right? And in order to raise capital, they're going to have to issue bonds. And anytime they issue bonds, supply and demand, it's going to decrease the value of bonds. So if they do issue a lot of new treasuries to fund this stuff, that could actually cause mortgage rates to worsen, not improve. So we shall see what happens there. Don't get me started on the big, beautiful bill. Trade deals, like I said, those are starting to wobble. When are we actually going to start to feel the impact of these tariffs? That is a big question mark. Again, multiple Fed members have said it might be several months before we start to see the impact of those tariffs really taking effect. How much is it really impacting things? We shall see, but it's going to be inflationary in nature. It's not going to be great for the economy. It's probably not going to be great for the labor market as well. Certainly, if businesses are making less money, they're not going to want to hire new employees. So it's a lot going on right now. And then finally, Middle East turmoil. Like, that has been a talking point all year, especially in June. Obviously, taking out, the underlying issues, which I can't talk about, don't want to talk about, beyond me, right? But financially, Middle East impact, talking about oil prices, right? It's hard to kind of dial it down to that, but that's what we're talking about. And oil prices, unfortunately, impact the cost of all goods. They have to ship them. So even if we were, looking at core versus non-core, headline versus core inflation figures, well, the increased cost of shipping is certainly going to bleed into the increase of the goods costs as well. So always a concern, always something to consider as well. So yeah, lots going on next month. Think that's it. Have yourself a wonderful month of July. Enjoy the rest of your summer, and I will see you next time. Thank you all so much for everything, including your referrals. It means the lifeblood. It is the lifeblood of my business. It means everything to my team and I. We try very, very hard. So thank you all so much for your continued support. Really, really appreciate you. Thank you all so much. See you next time. Thanks. Bye.